So now let's go back to my career. And I joined ExxonMobil in the year 2019. Helped ExxonMobil to set up trading business in Upstream. And right now I'm running the Quant team for ExxonMobil. And my team consists of 3 very talented PhDs. 2 of them are like mathematicians. 1 of them are computer scientists. And so here I am, and to give you some introduction of energy market. Hopefully it can motivate you to join the energy markets as a practitioner. And also hopefully it can give you some research topics. Before I start, I also want to go over the disclaimer as required by the company policy. All the materials presented here represent my personal opinions. This is today's agenda. And first of all, I'm going to make an overview of the global energy markets and talking about also the regional markets, how they are linked together. And then I'm going to present some general characteristics of energy price time series and to basically trying to differentiate energy from other equity classes or asset classes like equities, fixed income. And after that, I'm going to present the challenges in 3 areas. These 3 areas basically is how I bucket my business. The area number 0 is risk management. I call that number 0 because it is a prerequisite for us to do trading. And also as a quant, you see a array starts from index 0 instead of index 1. And also the first bucket is valuation and hedging. And here I'm going to review the option pricing theory. And then at the end, I'm also going to present the challenges in the trading and investing. So before I start, I would encourage you to raise questions, and I hope this session could be as interactive as possible. And this is a diagram basically shows you how the global energy markets can be decomposed into different regional markets. And whenever we talk about the energy market, generally we talk about 3 parts: oil, gas, and power. And even though right now there are also carbon markets, but mostly we talk about oil, gas, and power. And for each market, it also consists of a lot of regional markets. And for the oil or liquid markets, you have basically crude oil markets, refinery or refined products, and chemicals. They are very liquidly traded all over the globe. And for US, you have WTI. And internationally, people usually use Brent. And Canada has a WCS. And in Asia Pacific area, you have GCC. And also a lot of refinery products like gasoline, diesel, etc. And for the gas market, traditionally it's very regional. But starting from 10 years ago, due to the LNG, the gas market becomes more and more global. And North American market is well developed, very mature. And it was deregulated 30 years ago. It has already developed into a very mature market. And the major price index is Henry Hub, which is in Louisiana. And in different areas, especially the big 4 areas in the United States, we have, for example, Gulf Coast natural gas markers. For example, in Houston area, we have Houston Ship Channel. In West Texas, we have Waha. And also Northeast area, like New York, Washington, D.C., etc. And Mid-Con, like Chicago. And also West Coast, California and Seattle area. And this is North America natural gas market. And we also have a fairly liquid European natural gas market. And in European natural gas market, major price index is TTF. That is in Dutchland. And also we have UK, Germany, Italy, Spain regional indexes. And for Asia Pacific, we have GKM, which represents Japan, Korea markers. And if you ship natural gas market to China, Japan, Korea, you are going to use that index. And other than the oil and gas, we also have regional power markets. And in United States, the power market is run by ISOs. And for example, in Northeast area, the PJM, MISO, NISO, in Texas, ERCOT. The beginning of the year, Texas just experienced some polar vortex event. And in California, it's run by CAISO. In Europe, you also have regional power markets. So these are the global markets, and in different markets, we have different futures, options, spot prices, price indexes. Some of them are pretty liquid, some of them are like less liquid. And so market participants wise, you have producers like ExxonMobil, BP, Shell, and consumers or like utility companies, like in US, like all those power companies. And also you have funds, hedge funds, and trading companies like Vito, Trafigura. And you also have like investment banks like Goldman Sachs, Morgan Stanley, and hedge funds like Citadel. They all like participate in this global energy markets. And so regarding the markets, we can never avoid talking about the prices. And so this is very well-known quotes from a legendary investor, Jim Rogers, who says the price of a commodity will never go to zero. When you invest in commodities futures, you are not buying a piece of paper that says you own an intangible piece of company that can go bankrupt. And this is a traditional wisdom. Basically, commodity prices can never go down to zero. Or like when you model prices for equities, it is strictly non-negative price, or positive or zero. And but for commodities, it's a strictly positive price. However, is this really true? And I'm going to review some observable prices to against this idea. And before we even talk about the, yes, I showed just the global energy markets and its components. And then we moved here. And just a quote from Jim Rogers. And then let's review the price characteristics and the volatilities of two big asset class. One is equity, one is fixed income. For equity, like usually people use like SP 500 as a proxy to represent American equity market, and use a Barclay aggregate to represent a fixed income. And these two curves, the blue curve shows SP 500 index, the brown curve shows a Barclay aggregate, and shows you the total returns over the last 30 years. So eyeball these two curves, you can easily find there are like a positive drift over the time, or like over the last 30 years, they give you positive returns. And even though you can observe some significant drawdowns, especially for SP 500. So notably like a financial crisis, 2008, and most recent pandemic, and 2001. And also like down to the bottom is a chart show you the volatilities. And you can see SP 500 have a much higher volatility compared to fixed income Barclay aggregate. And also you have a volatility of volatilities, meaning volatility is never very stable. And especially like for SP 500, its volatility is very negatively correlated with SP 500 index. generally right now the correlation is around negative 0.9. And so people also check the VIX index. And so this is a very general characteristic regarding the equity and fixed income. And you can see SP 500 vol on average maybe like a 15 to 20% level annualized, and fixed income even lower. But it's very different in commodity market. This page shows you basically crude oil and natural gas spot prices. The blue curve as a top chart, which is using the left y-axis, shows you the WTI spot prices. And the brown curve shows you the Henry Hub natural gas prices, which is using the red y-axis. And you can see it's the number one difference from fixed income or equities is this time series shows a very strong mean reversion pattern. It's not drifting upward or downward. And also you can eyeball the time series of crude oil. You can see, especially during the last year, April 20th last year, the price recorded negative $37.63. So at least for the major energy index, it's no longer always positive. And actually in energy market, negative prices are not uncommon. For example, for United States power market, we have already, for a long time, maybe last 10 years, you always observe from time to time, electricity prices experience negative prices, especially during the late night hours. And because no one is using electricity and nuclear power plants is still running, so basically the utility company is willing to pay you to consume the power. And natural gas, similar story in West Texas, especially Baja. And because a lot of natural gas is associated gas, so when you get oil at the same time you have natural gas, but you cannot ship it out because you don't have transportation methods. So you are not allowed to just flare it or burn it at the wellhead. So you may want to pay someone to take it out. And so like positive price is no longer the correct assumption. And also like look at the bottom chart, which shows you the volatility. If you compare the volatility of commodities with either fixed income or equities, you will see these volatilities are much larger than either equity or fixed income in magnitude. And also you see a lot of spikes from time to time because this market is driven by the like very temporary supply and demand mismatch. And also in magnitude, sometimes the volatility could be as large as 200% annualized. That is very phenomenal. So since this is a quantitative finance class, and this shows you some summary statistics of the historical monthly returns for all this time series. For example, SP 500 on average, you achieve like roughly 1% mean return monthly, and which turned to be like a 12% annualized return. And Barclay aggregate is just a 0.5% per month. And but for crude oil and natural gas, generally it could be everywhere. And you cannot assume you have positive return or negative return. And also in general, power markets and natural gas market are right-hand scaled, and crude oil market is left-hand scaled or left scaled. And it has a very strong kurtosis compared to equities or fixed income. And also since you have negative prices And for negative prices, you can never define returns. And that may drive you to consider use normal distribution instead of log normal distribution to model your prices. And even though neither is correct.
You said even though neither is correct.
Yeah.
But with natural gas, just a second. So the skewness is really close to 0, and the kurtosis is close to 1. So is normality that bad of an assumption?
Yeah. Actually, natural gas, this is just a monthly markers. And in natural gas market, we also treat the daily markers. If I show you the daily markers summary statistics, you are going to see significant kurtosis. And but for monthly, it's not a very bad assumption for natural gas. And so regarding the modeling, and to model the total returns of either equity or fixed income, generally people use geometric Brown emotion with a drift term and a diffusion term. And so this is very common. And then there is an analytic solution for that, and people love it. And right now it tends to be a quoting convention, especially in the option market. So people simply quote the volatility, even though no one believes it's can be modeled by log normal, but still people quote in that way. And however, commodity markets, especially the spot prices, you can never use geometric Brown emotion because it's mean reverting. So usually people prefer to use the OU process to capture the mean reverting of the log prices. And why OU process? Again, because it's analytically solvable. There are a lot of other approaches, but since it's analytically solvable, I didn't present here. And so you can, from this modeling practice, you can tell some difference when we consider how to model the price time series. And the price time series I just presented stands for the spot prices. And we also have a fairly liquid future and option markets. And this shows you basically the current forward curves for both Henry Hub and Brent, and as represented by the top two charts, and also the volatility surface by the two bottom charts. And you can see, for example, the Henry Hub, the natural gas, has some seasonality for both forward curve and also the vol surface. Usually during winter time, and the price is higher, the volatility is higher, simply because people don't know how cold the winter could be. And during summertime, usually the prices is lower for the natural gas market. And for the crude oil market, it doesn't have a very obvious seasonality. And but right now, the crude oil market shows you a very big backwardation, means the front month's future price is greater than the back month's future prices. And also the volatility surface is much smoother for the crude oil than natural gas. And this is all driven by the seasonality in power and gas market. And also notably for the Brent, usually the pull side volatility is greater than the call side volatility, similar to SP 500. And so this page basically summarizes some characteristics of the future and options in energy market. And the forward curves are flipping between either contango or backwardation. Contango and backwardation are commodity terminology, basically stands for whether the slope of the future curve is either upward sloping or downward sloping. And the front months usually have higher volatility than back month. And this is generally called the Samuelson effect. And gas and power and also refinery products usually have seasonality. And crude oil have a higher volatility on put side, and natural gas usually have higher volatility on the call side. And also, especially starting from last spring, practitioners are seriously treating negative prices, because like all the options are quoted in by the Black-Scholes law, and the Black-Scholes formula basically have an assumption all the prices has to be positive. And so on April 20th, all the risk management system, all the option trading system basically just collapsed. And the option trading halted, and because people cannot quote it at all.
So what happened? It just stopped?
My trading floor actually are not very actively trading the options, but this is a market, and very weird in the last 2 years. But I will say last 2 years a lot of things happened. Like for example, GameStop, that stock skyrocketed from $3 to more than $200 in a few days. And crude oil prices dropped from $15 to negative $37. And this year, power prices skyrocketed in 1 day from $50 to $9,000. And also, just the last quarter, natural gas prices in Europe jumped from 30 euros to 155 euros. And this is a very, very crazy time. And also good time for quants to study.
So are the models being rethought?
Yes, a lot of models are being reconsidered. And also this imposed quite a lot of burden on the risk management systems, on the practitioners. And because you never want your model to fail completely, and you cannot even quote the market. So that's a very dangerous time. And especially this year, we experienced phenomenal prices is like power from $50 to $9,000 in 1 day. And that's very scary.
So do you think that there would ultimately be sort of like on the stock market where they put breakers in there if the markets go too crazy, they just stop? Do you think that might happen in the energy markets as well?
Probably not, because stock market, there are a lot of retail investors, those breakers, and also a lot of high frequency trading firms. And those high frequency trading firms usually have some positive feedbacks. So one firm do this, the other firm basically is using the similar algorithms. Therefore, it's very necessary to put a breaker there. But in energy market, most of them are institutional investors or energy producers or big utility companies.
For consumers.
Yeah, so it's a different story. Regulators may not be willing to jump in to regulate this market by putting breakers. That is my personal thoughts. I don't know how regulators or exchange is going to respond to this market environment. And so I bucket my business into 3 areas. Yes.
Oh, yes. So in the previous slide, you said that the front months are more volatile than the back months. Is that just because of the trading?
There are a lot of reasons for front months volatility is greater than the back months volatility. And because usually the front months, you have more information coming. And energy market is driven by the imbalance between supply and demand. And long-termly, basically, it's roughly balanced. You'll never see overinvestment or underinvestment significantly. But in the short term, weather could, you could have cold front comes and goes, and you could have some unplanned outages. For that reason, yearly, the front months is much more volatile than the back months. And also the front months have much more market activities.
So can I ask a question?
Yes. No
So,
problem.
my understanding is that the grid has to be balanced at all times, like,
Mhm.
and so that is one of the reasons that you went from 50 to 9,000, right?
Yeah.
So does that come into play in your efforts, or are you beyond that? I mean, is that?
That not $9,000 price is actually like a policy price. Basically, ERCOT says, hey, like since the supply can never meet the demand because like more than 40% of supply just evaporated, and even the pipeline companies declared force majeure, and you can never ever ship any molecule to the end user. So the basically ERCOT says like, hey, like let's set at $9,000, so that we encourage all the generators to ramp up, but it can never at that time period, just roughly 1 week period, supply can never meet demand.
And so so ERCOT is a Texas specific
Yeah.
entity. So if you look nationally or internationally, do these types of, I mean, I would assume the supply and demand are a little bit more slowly moving, I guess.
Supply demand, especially for the power market, is very instantaneous. And actually, this is not the first time we observe $9,000 like a price. In the summertime of 2019, we also observed like a $9,000 power price, but only for a few minutes. But this time this spring is very different. That price was maintained for almost 1 week. And so like that is a very different scenario.
How far did it go down after that week?
Mhm.
How far back down did it go after that week?
After that week, it returned to like a $50 to $100 range quickly, because everything back to normal, and you see all students come back to to the classroom, and everyone resumed normal life, and then the prices resumed normal range.
So never tie your personal energy use to the markets, right? So
Yeah.
there were some people.
And also some stories for that polar vortex that took place in the week of February 10th. There is a company called the Brothers Utility, and it was rated as single A company and a major regional utility. It went bankrupted just in 1 day. And there was some trader who only executed like 2 lots, and which is just a peanut by the trading floor standard, just 2 lots, and lost roughly like $100 million just in like less than 24 hours. And never ever assume you are already at the peak or at the bottom. And so this is importance of the risk management. And also like this spring, there was an event called Archegos. Like you see Goldman Sachs, Morgan Stanley were safe, but not other banks. And some bank lost roughly like $7 to $8 billion just within 1 week. So I would like to quote Nassim Taleb, the inventor of Black Swan. And he says, "We are convinced that studying the past will help us manage risk. You often hear risk managers, particularly those employed in the financial service industry, use the excuse, this is unprecedented. But Black Swan events don't have precedents." And however, also like some other well-known investor emphasize, the 4 most dangerous words in investing are, it is different this time. And even though like these 2 quotes looks very controversial or conflicting each other, but for me, it's very consistent. And this just basically drive our quants to think about in a more strategic way. in a more long-term way. And you can never ever just only study, for example, last 5-year data and make some conclusion. And also you can never ever only study the your regional market, trying to figure out what's going on or make any prediction. Probably you have to be better educated in terms of financial theory, and also even look at hundreds of years data. And actually a lot of people did so. They collected last 700 years data, for example, for financial crisis, and trying to draw some conclusion. And so I would say these two quotes are very consistent to each other, and but also keep in mind all these two. Regarding the risk management, it's a heavily regulated area, and usually the middle office take care of this, and there has to be a great wall between the front office and middle office. And there are also a lot of processes standardized, set up on all trading floors, and risk managers on a daily basis track a lot of risk metrics. The major ones are for example, the value at risk. And in energy industry, it's generally we are using 1-day time horizon, 95% confidence. And also we usually use several different methods. For example, parametric, always assume a normal distribution in returns, or historical, and that gives you the fat tail, or Monte Carlo simulation if you have a portfolio of nonlinear assets. And but value at risk is not coherent, and so the Basel III started to adopt a conditional VAR, or also known as expected shortfall. And people also worry about the tail risk a lot, so they use stress tests. And stress tests are very regulated in the banking industry, like a Federal Reserve have their CCAR or DFAST processes conducted annually, and to stress test all the banks in the United States. And people also track the credit risk in terms of XVA or potential future exposures. And liquidity risk is also a big headache. And so usually on top of the VAR, people calculate liquidity VAR adjustment. So these are all the just a part of the risk metrics people are using. And beyond that, people designed a lot of risk limits. So limits means all traders and analysts, controllers have to respect and keep tracking of. Whenever limits got breached, you have to either immediately unwind your position or stop your trading, depends on the situation. And you have a position limit, value limit, VAR limit, stop loss limit, credit limits, blah, blah, blah. And depends on which desk you are working on. And also a lot of processes, either intraday or end of day, kick off at different time, and trying to give people a hunch of their risk, or how much risky is their portfolio. And some processes kick off daily, or even in the intraday, some quarterly or semi-annually or monthly, and a lot of processes. And these are generally standardized already by different standards like Basel or CFTC or FERC. And so you can check standards, but standards always lag behind the market. So no one would expect pandemic could be this this way, and no one could either expect the rebounding could be this fast. So we have a lot of challenges, especially in risk management area. The number one probably always is a tail risk or extreme events, and especially for last 2 years. And people keep talking about, I observe another unprecedented event take place. And if you calculate the ex ante probability or frequency. It could be happening once per 1,000 years or once per 1 million, 1 billion years. But it keep happening every few months. And like the polar vortex this year, the European natural gas last quarter. How to predict? I would say you never try to predict extreme events. You just need to know it's going to happen sooner or later. So just like an insurance company, and you probably can never predict when the earthquake is going to happen. But you need to make sure whenever you are writing an earthquake policy, you want to charge enough risk premium for that. And another headache, especially for energy market, is also the correlation. Correlation is a monster. And I would say correlation from statistic perspective makes sense for me only for the multivariate normal distributions. If you have a multivariate non-normal distribution, and correlation generally is misused term. So people use copula to model the dependency. And unfortunately, quants and copula were attributed to be one of the big reasons to cause a financial crisis 2008. So there is no general approach or some approach that can solve the problem. It's just usually it is just some market quoting convention. So everyone feel, oh, this is a good technique, and I'm going to quote that by quoting the correlation or quoting the wall. And but it never means the market is going to behave in this way. So always keep in mind, market is a monster, and models are just models. All models are wrong, and some models are simply useful. And also after financial crisis, people are started to be aware of the model risk. And this is a problem already in the banking industry. So you can see in all banks, there is a big model validation team. They validate all the models, challenge the assumptions of your models, but still you have a model risk, and you have a basically galaxy of risks. And then also you see all the risk management generally are based on some statistics looking backwardly. And but trading is always forward looking. So whenever it's backward looking, there is always problem how long you are going to include in your analysis, whether it lasts 1 year, 10 year, 100 year. And forward looking is how brave you are. And so this is a reason why when I talk with quants, I always mention economic theory is one pillar you shall never ever forget. And in the credit market, also we have the problem either through the cycle or point in time. And through the cycle means your credit rating may want to be through the cycle so that you can help your clients to survive different cycles of the economy. And also regulators want your credit ratings to be through the cycle. And but traders always want to be point in time because they are expecting, for example, bankruptcy to be happening tomorrow, and they don't want to get any loss. But regulators don't want your credit rating to pro-cyclic. Otherwise, everyone behave in the same way that cause some systematic trouble. And so there are always some debates in the regulators whether the ratings need to be through the cycle or point in time. And actually for all the models, you have also need to consider. This is actually consistent with whether your model shall be forward-looking or backward-looking, and whether it should be mean reverting or not. So this is risk management. Next one, I'm going to talk about the second bucket, the valuation and hedging. And usually working in energy companies or investment banks, you have a fairly large structuring team. Basically, their responsibility is to originate deals. These deals could be very complex and consist of a lot of optionalities. And the reason for that is because people always want to customize the contract. So we customize the deal and invent all kinds of options. People could either like leverage, and we could make our clients happier or make ourselves happier. And then valuation and hedging inevitably involves the modeling, especially of your risk. So this is a quote I especially like from the well-known Quant man German. He basically says the best quant finance brings real insight into the relation between value and uncertainty. And it approaches the quality of real science. The worst is a pseudo-scientific hodgepodge of complex mathematics used with obscure justification. This is actually what we encounter every day. A lot of PhDs are trying to sell their models without any empirical application, or all the assumptions are wrong. And so this is very important as a practitioner, and all models are wrong, and but you have to make very realistic assumptions to make that model useful to you. And regarding the valuation and hedging, and basically starting from the model portfolio theory, and Black-Scholes, it's generally adopted. The value of the deal basically depends on the cost to hedge the deal, especially the short term. And so the valuation basically is equivalent to the hedging cost. And so here I'm just trying to review the two fundamental theorems in finance. And before we even start to talk about that, let's just revisit the mathematical definition of arbitrage, because that is just the key concept in all the arguments about the valuation. And the arbitrage basically have three conditions. You start with zero money, or like a zero, and empty pocket. And then with no chance, you are going to lose money. But with strict positive chance, you are going to make some money. And this is arbitrage. If the market is liquid enough or efficient enough, there shouldn't be any arbitrage opportunity. For that reason, the value of the deal equivalent to the hedging cost. And so the first fundamental theorem of asset pricing basically says a market is arbitrage free if and only if there exists at least one valuation measure or probability measure Q that is equivalent to empirical measure P. Basically, that says like you have some solution of your equations, and but that solution could not be unique. You could have several solutions. As long as the constraints of arbitrage is not violated, that solution is okay. Or turn it into financial terms, that could be could mean the risk premium is not unique, and you simply need to charge enough risk premium. And however, like I just found in energy market, a lot of people simply use the second fundamental theorem of asset pricing, which says the arbitrage-free market is complete if and only if the Q measure is unique. If Q measure is unique, that means your solution is unique, or means no matter whether you are talking with Goldman Sachs or JP Morgan, they are going to quote you the same price. And or no matter whether you are talking with Allstate or AIG, you are going to get the same insurance policy. And so a lot of financial papers are just assuming like the market is risk neutral. And that essentially means the market is complete. Everything is hedgeable. And unfortunately, that's generally not the case. But it doesn't matter, like a lot of people just assume you can use risk neutral to do the pricing. So like also I want to briefly like revisit what you learned in the financial engineering classes. The binary model to price a call option. And the binary model can be used to model stock prices in the future. And basically, S0 here stands for the current stock price or any price. And SU stands for the one scenario, the up scenario, which is going to be realized in the future. And also you have a down scenario. And then you can use this binary model to price a call option. And the idea of the valuation is, hey, you have two scenarios, either up or down. And you have two unknowns. One is the option value, and the other one is the hedge ratio, delta. And so two scenarios, two unknowns. And you need to solve the option value, and also at the same time think about if you can construct a self-financing portfolio, use the money market and also the underlying to hedge this option. And if there is some risk-free or arbitrage-free strategy you can use, then you can basically solve both the hedging ratio, the delta, and also the option value. So if the market is truly this binary and the bond, you solve the equation, and this is a very simple linear equation system, you can uniquely determine both the option value and the hedging ratio. So this is probably the most frequently used argument for the arbitrage free valuation, and also the binary case for our call option valuation. And this also depends on the basically the second theorem, and the market is complete. And but there is also another approach which I personally very prefer, and in the finance classes it's usually called the pricing kernels or stochastic discount factor. And basically in this model, people said, hey, my discount rate is no longer deterministic. It's a probabilistic or stochastic. And the discount factor depends on the state I'm in. And if I'm in the up state, I use one discount factor. If I'm in the down state, I'm using another discount factor. So I have two assets, either the stock or the bond. I have two discount factors to be solved, either up or down scenarios. So I can uniquely solve the discount factors, these two discount factors. And then after I solve this linear equation system, I use these two discount factors to price the either call or put options. And within our expectation, you are going to achieve exact same solution as a previous approach. And I prefer this one because this one is more universal, or have more applications, especially when we are in incomplete market. So this is empirical scenarios we are experiencing every day. And you can have this scenario, the model is not binary. You have a lot of branches. Today's market is $100. Tomorrow you have 4 scenarios instead of 2. And also your underlying may not be tradable at all. For example, you have a weather option, and the weather itself cannot be traded. And the temperature, you can only wait until the maturity to observe what is the realized temperature. And so this make your valuation very challenging. And basically you are in an incomplete market, so you have to think about your risk premium all the time. And usually our way is to split the valuation into 2 parts. The part is hedgeable, and then you can assume the market is very liquid. You can hedge part of the risk, and that part you use risk neutral valuation methodology. And then for the non-hedgeable part, you have to think about the risk premium you have to charge to protect the company. And so in energy markets, you see we have a lot of options. A lot of them are real options. For example, pipelines, storages, LNG cargoes, regas facilities, refineries, power plants. They can all modeled by options, even though not vanilla options. They are exotic options. And also you have quite a lot of financial options, European, American, Asian, Bermudan, binary, swing option, look back. And in terms of valuation methodology, sometimes it's risk neutral, sometimes you have to use a stochastic discount factor. And even though the latter one is not widely adopted, because people generally prefer some analytic solution, some easy way to solve the market. And regarding the trading, it's also very challenging. And when talk about the trading, we can never just skip the efficient market hypothesis. So this is a very well-known joke. A finance professor and a student who come across $100 bill lying on the ground. As the student stops to pick it up, the professor says, "Don't bother. If there was a really $100 bill, it wouldn't be there." So this is also used as one of the arguments against the efficient market hypothesis. So the mathematically efficient market hypothesis could be represented as the excess return, which is defined as the total return minus the risk-free interest rate, can be decomposed into alpha and beta and the residual part. And the beta is standing for the systematic risk. And alpha basically represents the trader skill. Efficient market hypothesis basically argue against the trader skill, or you can easily beat the market, and everything shall be based on some systematic risk, even though this systematic risk may not be only represented by SP 500. And regarding the commodity futures, and there are quite a few different theories. For example, the theory of storage basically means the future prices is determined by the storage levels. The lower the storage or inventory levels, the higher the price. And also the hedging pressure. And this went back to Keynes in early 1930s. So as a producer, they have the intention to hedge their profit margin. And therefore, as an investor, you can take advantage of that by providing the hedge. So that's advantageous to basically long commodities. But different theories could have different proponents, and from time to time, now these theories are dominant theory. So also most recently, people started to use a carry value momentum sentiment to capture the factors in the commodity market. And so on our trading flow, we basically do this business like hedging. And generally, oil majors don't hedge their production, but it doesn't mean for some special projects we're not hedging. We probably need to do hedge in order to secure our capital investments. And also we do arbitrage a lot because this is not a liquid market, at least not as liquid as FX market. So there are a lot of arbitrage opportunities. And also because we are ExxonMobil, the number one. And so a lot of people are willing to do business. And we have also a lot of real assets in terms of storage, pipeline, LNG cargoes. We can realize extrinsic values, or the basically realize optionality from those contracts. And also we do a little bit speculation and market making. So finally, I probably, especially regarding the risk trading, I have some thoughts. It's well known there is some difference between econometrics and machine learning. And I know data science or machine learning is very popular nowadays, mostly because of the AI and Silicon Valley. But economics is very different from machine learning because economics usually trying to recover the causality relationship. And this is very different from correlation relationship. And also like you are facing a small sample problem, you don't have enough data. And therefore economic theories are always important. And also like there are some well-known paper talking about how to apply the data science in finance and whether the machine can learn finance. And there are some hurdles we need to overcome. For example, in finance, there is a very small signal to noise ratio. The market is keep evolving and data are usually unstructured. And also you have a very small sample size. It's not that easy to just quickly use machine learning to predict price. And also it's very important people need to know you have to avoid data mining. If you try millions of models, you definitely will find a lot of models went through your t-test with t greater than 2. But if you already tried 1 million models, that's not a surprise. That usually is just a false alarm. And data mining is not a good word on the trading floor. And so I would like to quote Warren Buffett to conclude my presentation. And in the business world, the real mirror is always clearer than the windshield. Thank you.